If you've been keeping an eye on the real estate market, you may have heard about a significant event in the world of mortgages, a sudden and substantial drop in mortgage rates. This drop is the largest one-day decrease in the past 6 months. The big question on everyone's mind is, could this be a sign of another housing crisis on the horizon? We've got some breaking news that could impact your dream of owning a home. In this video, we are going to break down complex financial topics into bite-sized, easy-to-understand pieces. Picture this. Just when mortgage rates were soaring to a historic 23-year high, the financial world witnessed an unexpected twist. In a single day, 30-year mortgage rates plummeted, marking the most significant one-day drop since early March. But here's the big question that's been buzzing around. Could this dramatic rate plunge lead us into the haunting echoes of the 2008 housing crisis? Let's dive right into it. To explain what happened first, we need to start with a brief explanation of mortgages. You might already be familiar with this concept, but let's clarify it. Essentially, when someone wishes to buy a house, they often borrow hundreds of thousands of dollars from a bank. In return, the bank receives a document known as a mortgage. Each month, the homeowners are required to make payments to the bank, consisting of a portion of the principal amount borrowed plus interest. This payment is made to whomever currently holds that mortgage document. However, these payments don't always go directly to the bank because, quite often, the original lender, which is the bank, chooses to sell this mortgage to a third party known as an investor. This practice was quite common. Before we continue our journey into the world of mortgage rates and housing markets, I'd like to ask for your support. Please hit the like button to show your engagement and excitement for this topic. Don't forget to subscribe and ring that notification bell to stay updated on our upcoming financial insights. Traditionally, securing a mortgage was a challenging endeavor if you had a poor credit history or an unstable job. Lenders were naturally risk-averse and hesitant to extend loans to such individuals. However, all of this began to change in 2008. While investors, traders, and bankers were pouring substantial sums of money into the U.S. housing market, the prices of homes were on an upward trajectory. The combination of relaxed lending requirements and historically low interest rates propelled housing prices even higher. This, in turn, made investments in mortgage-backed securities and CDOs appear exceptionally attractive. Now, here's where things took a twist. If borrowers defaulted on their mortgages, one might think the bank would still possess the highly valuable house, but that was not entirely accurate. Let's pivot to a thought bubble, or rather, the concept of a housing bubble. You're likely familiar with the idea, a rapid surge in home prices driven by irrational decisions. Unfortunately, these bubbles have a knack for bursting, and the one in 2008 was no exception. As housing prices soared to unimaginable heights, people found it increasingly difficult to keep up with their exorbitant housing costs and ballooning mortgage payments. Borrowers began defaulting on their loans, flooding the housing market with properties for sale. The problem? There weren't enough buyers in the market to match this surge in supply, creating a stark mismatch between supply and demand. This disconnect led to a cascading effect, causing home prices to plummet. Some borrowers soon discovered that their outstanding mortgage balances exceeded the actual worth of their homes. As a result, many simply stopped making payments, which only compounded the issue with more defaults, further depressing housing prices. By 2007, significant players in the financial industry had declared bankruptcy, signaling a deepening crisis. The problem extended to large investors who had poured substantial sums into these financial instruments. As these investments soured, the U.S. economy was thrust into a sudden and severe recession. Now, once again, let's delve into the question of whether there's a chance of history repeating itself with a housing crisis like the one we witnessed in 2008, where we've witnessed a sudden and historic drop in 30-year mortgage rates after a period of soaring rates. This has left many wondering whether we could be on the brink of a repeat of the 2008 housing crisis. However, there are several compelling reasons why this is unlikely. Tighter lending standards. Unlike the loose lending standards of 2008, today's lenders are required to meticulously verify borrowers' income and assets before approving loans. This stringent scrutiny ensures that borrowers have the financial capacity to meet their loan obligations. Reduced risky subprime lending. Since the 2008 crisis, regulations have imposed strict limits on subprime lending. This means fewer borrowers are obtaining high-risk loans that they might struggle to repay. Lower household debt. Household debt levels have significantly decreased since 2008, affording borrowers greater financial flexibility and reducing the risk of loan defaults. Low housing supply. Currently, there is an unusually low supply of homes available for sale. This scarcity is expected to provide support to home prices and minimize the likelihood of a housing market crash. Additionally, policymakers and regulators have taken extensive measures to fortify the stability and resilience of the financial system. These efforts include imposing stricter regulations on banks and other financial institutions. So, here's the reassuring news. While lower mortgage rates can stir up the housing market, they aren't the sole villains behind a crisis. The financial world has learned from its past mistakes. Today, there are stricter lending rules in place, making sure borrowers can actually afford the loans they take. There's a vigilant eye watching over the financial industry to prevent any foul play. We're in a different era. So, what does this all mean for you, the aspiring homeowner or investor? The drop in mortgage rates is indeed good news. It can make buying a home more affordable and potentially kickstart the housing market. But remember, the housing market is a complex world with many moving parts. Before you dive headfirst into the world of mortgages, be sure to do your homework. Consider your budget, explore your options, and keep an eye on the bigger economic picture. Stay informed, stay cautious, and you'll be well on your way to achieving your homeownership dreams. Now, we've shared our insights on mortgage rates and the housing market, but we want to hear from you. What are your thoughts on the recent rate plunge, and how do you think it might impact the real estate landscape? Drop your comments below, and let's start a conversation. And there you have it, folks. We've dissected the thrilling world of mortgage rates, unraveled the mysteries of the housing market, and ventured into the haunted shadows of the 2008 crisis. But our journey doesn't end here. Stay tuned for more exciting financial adventures on my channel. And don't forget to like, subscribe, and hit that notification bell to join us on this incredible journey. Until next time, stay curious and make informed decisions.